Recently, gold has once again become the center of market attention. Since last Wednesday, its price has dropped by almost 10%. Whenever such sharp moves happen, people start asking, is it still a good time to buy gold? Or where will gold go next? But as long-term investors, what we should really focus on is not gold's short-term ups and downs, but a deeper question. What role should gold play in our long-term investment portfolio? A recent research paper from D.E. Shaw gives a very interesting answer to this question. In a previous video, we already discussed the value logic of gold. In this one, we will go a step further to explore gold's position in an investment portfolio and whether it still makes sense to hold it in the current market environment. To understand gold's role, we first need to understand what it really is. Many people think of gold as a commodity, but in essence, it is closer to cash. Gold is an ancient form of money. The difference is that it does not rely on government credit and cannot be printed at will. Historically, gold has maintained its value because it carries no default risk. According to D.E. Shaw's research, over very long periods, the total value of gold has grown roughly in line with global wealth, or GDP. If gold rose much faster than global wealth, it would eventually represent all wealth. If it grew much slower, it would fade away. In reality, gold's share of total global wealth has stayed stable, between 1.8% and 7.3%. This means gold acts as an anchor for global wealth, a relatively steady measure of value. Because of that, gold's price movements are not mainly about changes in its own value, but more about changes in the purchasing power of fiat currencies. Gold, however, is not exactly the same as cash. It does not generate any cash flow. Over the long run, its real return is only about 1%. That means gold does not pay interest or produce income. You cannot expect gold to make you money, but when the financial system faces problems, it helps preserve your purchasing power. For this reason, gold has always been a defensive asset, not an aggressive one. When we talk about gold's position in a portfolio, the first thing to look at is how it relates to other assets, which we call correlation. These relationships can all be explained by a few basic economic drivers. Broadly speaking, there are three main factors that shape how gold moves with other assets: real interest rates, economic growth, and inflation. Let's start with real interest rates. This is one of the most important factors influencing gold prices. In our earlier video about gold's value logic, we explained that holding gold has an opportunity cost. When you hold gold, you give up other assets that earn income, such as bonds or savings with interest. When real interest rates rise, the opportunity cost of holding gold also rises and gold prices tend to fall. When real rates drop or turn negative, the cost of holding gold decreases and gold becomes more attractive. That is why gold prices usually move inversely with real interest rates. Since bond prices move in the opposite direction of interest rates, gold and bonds tend to have a positive correlation overall. The second factor is economic growth. The relationship between gold and growth is more complex. On one hand, gold represents the anchor of global wealth, so in theory, it should move in line with global wealth expansion. Economic growth means wealth creation, and gold's share in that wealth tends to expand as well. On the other hand, gold also serves as a safe haven asset. When growth slows or market volatility increases, investors turn to gold for protection. In these times, risk assets like stocks often fall and gold performs better. Because of these opposite forces, the correlation between gold and stocks fluctuates a lot. Over the past 50 years, the average correlation has been only 0.01 and has changed direction many times. This means the relationship is dynamic. During economic expansion, the correlation may be slightly positive, while during risk periods it becomes negative. Over the long run, these effects offset each other, and the net correlation between gold and stock stays close to zero. The third factor is inflation. Theoretically, gold is viewed as a store of value that can hedge inflation. When inflation rises, purchasing power falls, and people are willing to pay more for gold to preserve value, so prices tend to rise. But in reality, it is more complicated. Inflation and interest rates are often positively related. When inflation goes up, central banks raise rates to fight it, which lifts real interest rates and suppresses gold prices. These two effects cancel each other out. The data also supports this. Since 2004, the correlation between gold and inflation has been about 0.13. That means gold does have some ability to hedge inflation, but it is far weaker than most people think. Gold can hedge inflation, but this effect only becomes clear over very long time horizons. At the same time, we must also talk about a very important point: the relationship between stocks and bonds. In traditional asset allocation theory, we often assume that stocks and bonds move in opposite directions. When stocks fall, bonds usually rise, which helps diversify risk. But in reality, things are not that simple. In our previous video about the optimal long-term portfolio, we mentioned that over decades, bonds cannot truly offset equity risk. Their diversification effect weakens a lot. The reason is that the correlation between stocks and bonds is not fixed. It keeps shifting as inflation, interest rates, growth, and policy cycles change. For example, from the 1970s to the 1990s, stocks and bonds were positively correlated. After the year 2000, with globalization and a low inflation environment, the relationship turned negative and stayed that way for about 20 years. But since 2021, with inflation coming back and interest rates rising sharply, the correlation has once again turned positive. Taking all these factors together, we could draw a deeper conclusion. Gold is a highly cyclical asset. Its performance and function depend entirely on the macro environment. In some periods, it can become the most defensive and eye-catching part of a portfolio. In other times, it may do almost nothing. Based on this understanding, D.E. Shaw proposed a useful model in their research. They put stocks, bonds, and gold into a three-asset framework and divided the market into four quadrants using two dimensions. The first dimension is whether the correlation between stocks and bonds is positive or negative. The second is whether there is systemic risk or crash pressure in the market. In the first scenario, when stocks and bonds are negatively correlated and the market is stable, the traditional stock and bond portfolio already provides good diversification. Bonds naturally hedge stock volatility, and since overall market risk is low, the demand for safe haven assets is limited. In this case, gold's strategic value is small. The allocation can stay in the low single digits or even be skipped in aggressive portfolios. In the second scenario, stocks and bonds become positively correlated while the market remains stable. This means they start moving together, both rising and falling, so the traditional hedge fails. Even though there is no crisis, gold's value as a diversifier increases significantly because it is one of the few assets with low correlation to both. During this period, gold's allocation weight should increase. In the third scenario, stocks and bonds are negatively correlated, but systemic risk appears. Bonds still offer some hedge, but the demand for safe haven assets rises quickly. Investors prefer assets with no credit risk. In this environment, gold's defensive role becomes very clear, so its allocation should rise accordingly. The fourth scenario is the most extreme and also the one where gold deserves the highest allocation. In this case, stocks and bonds are positively correlated and systemic risk exists. When a crash happens, both stocks and bonds drop, and the traditional hedge completely breaks down. Here, gold becomes crucial because it serves two roles at once. It diversifies risk and also acts as a safe haven asset. Research results show that in this environment, gold should have the highest weight. Ray Dalio once suggested that for most investors, the optimal allocation for gold should be between 10% and 15%. To sum up, the core idea of this model is that gold's performance is cyclical, so ideally its allocation should be dynamic. When markets are stable and stocks and bonds hedge each other, gold may seem unnecessary. But once traditional mechanisms fail and risks stack up, gold becomes the most important part of the portfolio. At this point, many people might be wondering, where are we now? Ray Dalio actually gave an answer to this in his recent article Sanctions, Geopolitics, and Gold. According to his analysis, today's global market is in the fourth quadrant of this model, where stocks and bonds are positively correlated and systemic risk exists. Dalio believes we are in the late stage of a major long-term cycle. Global debt levels are very high. Fiscal deficits keep expanding, and governments rely on money printing and stimulus to keep the system running. At the same time, monetary policy and geopolitics are becoming deeply intertwined. The US dollar has been weaponized, sanctions are now common, and trust in the reserve currency system is eroding. In such an environment, the credit system is becoming more fragile, and the performance of stocks and bonds is increasingly synchronized. When inflation rises and interest rates go up, both bonds and stocks tend to fall. When economic data weakens and markets expect easing, they rebound together. In other words, the old pattern where stocks and bonds moved in opposite directions has broken down. This perfectly fits the fourth quadrant we discussed earlier, where stocks and bonds are positively correlated and systemic risk exists. In this setting, the traditional defensive role between asset classes disappears, and portfolio volatility rises instead. Against this backdrop, gold's strategic importance is once again becoming clear. Gold is the only globally recognized asset that does not rely on government credit, cannot default, and cannot be sanctioned. Even though gold might be slightly overbought in the short term, from a medium to long-term perspective, it still holds strong strategic value. Especially after last week's noticeable pullback, now could actually be an attractive time to start building a position. How much gold do you currently hold in your portfolio? Share your thoughts in the comments. If you found today's content insightful, remember to like the video, subscribe to the channel, and turn on notifications so you do not miss future updates. See you next time.